You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors. Hey, thanks for tuning into this episode of the Tax Smart REI podcast. Today, we're going to answer a question that we get all the time from both Tax Smart insiders as well as clients, and that is, should you reduce your taxes to zero? And it's tempting. Sometimes people want to pay no taxes for the sake of paying no taxes. Sometimes they just want to stick it to the IRS, or in some cases, there's a more practical purpose for reducing your taxes to the lower tax bracket. So we're going to be going through all of that in just 1 minute. Attention real estate investors, are you ready to maximize your investment returns and minimize your taxes? Then look no further than ELB Consulting, leaders in cost segregation. If you're serious about keeping more money in your pocket, then this is for you. Why choose ELB Consulting? ELB's fully engineered cost segregation studies dive deeper, bringing more tax benefits to the forefront, ensuring that no detail is overlooked, allowing you to keep more money where it belongs, in your pocket. Experience the ELB advantage with detailed cost segregation reports, a proven track record, and lifetime audit defense. Don't leave money on the table. Discover how cost segregation studies can lead to significant tax savings for you. To learn more, contact Bill Smith at bill@elbcostseg.com. Again, to learn more, contact Bill Smith by emailing him at bill@elbcostseg.com. That's all for now. We'll jump right into today's episode. So before we dive right into the question and get to the answer, we need to first understand how the U.S. tax system works. Now, we're not going to bore you with all of the details, but the U.S. tax system is a marginal tax system, so that means you're not always paying taxes at the top rate. So for example, if you're at the 37% tax bracket, you're not paying 37 cents on every single dollar that you earn. You're paying some at 10%, 12%, 22%, 24%, all the way up. Ryan, do you want to go into like a little bit of more detail of kind of what tax brackets are and kind of how all of this works?
Yeah, you said marginal. Someone could also say progressive. So as you make more income, basically your tax rate that the income's being taxed at is at a higher rate. So yeah, that is a common misconception. Oh, like people will say, oh, I want to get down from the 32% down into the 24%, right? Because they're like, oh, that's an 8% difference. That's quite a bit. But if they're only over into that 32% bracket by like $100, well, only that $100 of that income is taxed at 32%. Everything else is, 24% or 22 and 12 and whatnot. So that's kind of the big picture way to look at it. As far as, we could talk about different filing statuses, single, married filing joint, head of household, things like that. That's one of the first things, even in tax classes for college, that we basically learned and understand. You got to figure out what status you are. That should be fairly self-explanatory to most people. But then we get into the actual brackets themselves. So for example, I'm just going to look at 2024. And you might be wondering, where are you looking at this? Where do you find this? You can find this on the IRS website. I typically like to look at something like NerdWallet or something like that. It's just a little bit more accessible. I can kind of look at things a little bit more fast and easy. So I'll just read based off like 2024 tax brackets, for example, married filing joint. Okay. So basically, if you make taxable income, and that's one thing I'll just highlight here, this tax is based on taxable income. It's not based on total income. It is based on taxable income, which is after things like standard or itemized deductions, QBI deductions, things like that. So just want to highlight that this is taxable. Essentially think it is the bottom line on the first page of your 1040. Okay. So for example, I'm not going to read all of them, but just to give you a taste, right? The taxable income between $0 and $23,200 for married filing joint, you're going to pay 10% tax on that. Okay. Then any income between $23,201 to $94,300, you're going to pay tax at 12% only on that little bracket of income. Okay. Only the income between $23,200 and $94,300. And then the last one I'll just say, just for the sake of keeping this short, if you have taxable income between $94,301 to $201,050, just that bracket of income, just between that 93 and that 201, that income itself is subject to 22. And then it just kind of continues on, right? We don't need to go into every single one, and people can see that online. But point is, progressive marginal tax brackets system that we're in, that's how we work. Don't get confused that just because you hit a certain bracket that all of your income is subject to that. You will get to a very different tax calculation.
Yeah, no, absolutely. Very well said. Now, one more thing I want to throw out there before we move on here is a calculation or a number called modified adjusted gross income, also known as MAGI. Now, a MAGI is a little bit different from your taxable income, and it's a little bit different from your AGI, your adjusted gross income. So all these numbers are important. However, the reason why MAGI is important is because MAGI is often used to determine your eligibility for certain types of tax credits, tax deductions, and even some forms of income, right, or some forms of payments that you might be making, like student loan payments or Medicare payments, can be impacted by MAGI. So that's another important number just to kind of keep in mind. I'm not going to go through all the details here today, but just know that some numbers are added back to your adjusted gross income when determining MAGI. And some of those include student loan interest, tuition and fees, IRA contributions, so traditional IRA contributions that were tax deductible, passive activity losses. So if you don't qualify for reps or you don't qualify for the real estate professional status, and there's a handful more. You can go Google that as well. There's plenty of lists out there. You can find that. But just keep in mind that that number, modified adjusted gross income or MAGI, is important. All right. Now we're going to get into why do people want to reduce their tax liability to zero? Well, we kind of already mentioned some of this in the introduction, but sometimes people just want to reduce it to zero for the sake of having bragging rights. They paid no taxes, right? You can go tell your friends, hey, I paid no taxes last year. I paid zero taxes for the last 10 years, right? That's some reasons, right? Bragging rights. Or sometimes people just want to stick it to the man. Some people just say, hey, I don't want to pay the IRS any money. I hate giving my money to the IRS, so they want to pay the IRS zero. But then there's actually some more practical reasons, right? Some of the more practical reasons are kind of what we just discussed. If you can reduce your modified adjusted gross income and thus your taxes, then you're able to actually qualify for certain deductions and exemptions and credits and stuff that you're not normally eligible for in the higher tax brackets. So we're going to cover some of those right now.
Before we move into some of the credits and exclusions and things like that, getting your taxable income to zero, again, sounds cool. It can be good, but at the end of the day, if someone comes to me and they say, hey, I've got my taxable income to zero, an honest question could be, how did you get all these losses, right? And for real estate investors, that could be something like a cost seg, and we've got extra depreciation, and that's, not a cash flow issue, right? It's not cash. But I have seen where other tax returns, it's like, hey, I run a business and I just have this huge NOL, net operating loss for people listening. I have this huge net operating loss because they actually lost a ton of money, right? So that's like, it's not always just 100% of the time, hey, taxable income to zero is a good thing. It might be truly because you've got a business that is really having a lot of losses. I saw a couple tax returns of people who got taxable income to zero, yes, but it's because they had such large NOLs from their businesses because of COVID, right? So it's not always like, hey, just this, fancy thing, 100% want to get that too. It could actually be like you had something terribly go wrong and it just, that happened. But as far as like, hey, we're doing well, we've got good cash flow from our businesses and real estate, great. If we can now help you continue to increase that cash flow by reducing your taxes, and now you keep more of that money that you've made from the profit of your business and cash flow of your rentals, right? Great. That's one way that we're now being more tax efficient and helping you reduce that. And we'll get into some other things there. But now moving into a couple other things as far as like what credits could be impacted by modified adjusted gross income. So one of them would be like the child tax credit. If you've got kids, that's going to impact you. American Opportunity Tax Credit. Another one, lifetime learning credit, right? All those things for kind of education expenses. Savers credit, premium tax credit, adoption credit if you're adopting, and then the earned income tax credit. So those are just a couple that are impacted by modified adjusted gross income, MAGI, that you are going to be wanting to think about as far as an impact here.
Hey, are you tired of working with generalist CPAs that tell you can't use the real estate professional status, the short-term rental loophole, or cost segregation studies, or worse, have no idea what these things are? If so, it's time to elevate your game and work with a CPA firm that gets it. Here at Hall CPA, we worked with thousands of investors, helping them save millions of dollars in taxes through proactive tax strategy and planning, tax preparation, and outsourced accounting solutions. So if you're ready to elevate your game, make tax filing painless, and save thousands of dollars in taxes, what are you waiting for? Just head on over to www.therealestatecpa.com/podcast to request an initial consultation today. We are accepting clients for the 2023 and 2024 tax years, so if you're looking to make a change, you have nothing to lose. Again, you can request an initial consultation by visiting www.therealestatecpa.com/podcast. We look forward to hearing from you and learning more about your situation and how we can help. But for now, we'll dive right back into today's episode. Yep. So basically, long story short, if you're going to be eligible or you want to claim some of these credits, reducing your modified adjusted gross income and thus your taxable income and your tax liability has practical utility, right? There's practical reasons for doing this other than bragging rights. Now, there's some exclusions and adjustments that might impact your modified adjusted gross income. Kind of went through that a little bit. So we're going to go ahead and I'm going to briefly run through that. And then I'm going to talk about some other items that are involved in MAGI. And I know everybody's waiting for like, how do you actually reduce your MAGI, right? We'll get into that a little bit later on in the episode. But right now, just note that, okay, exclusions and adjustments that are going to impact your modified adjusted gross income will be your eligibility for an IRA contribution. You might have to do a backdoor Roth if your MAGI is too high. Certain exclusions of U.S. bond interest, exclusions of employer-provided adoption assistance, and foreign earned income credit exclusion can all be impacted by your level of MAGI as well. So just another reason, or a few other reasons, why you might want to reduce that MAGI. Now, here's some other items as well. And these are recent items that I've came across. Medicare Part B and D premiums. If you're below certain MAGI thresholds, you could be paying less premiums. The net investment income tax, child and dependent care credit, residential efficient property credits, and student loan payments. That's a big one for medical professionals. I've seen a lot of medical professionals who have high incomes, right? But they have a ton of student debt, and they're trying to get their MAGI lower so that their monthly payments on their student loans are lower, because sometimes those student payments are going to be reflected based on your modified gross income. So that's just another important reason, or another practical reason, why someone might do that. So now that we kind of covered what could be impacted by your modified adjusted gross income and why you may want to reduce it, the question really becomes, is it really practical to reduce your taxable income to zero? And is it necessary to claim any of these deductions, right? Like, will getting to zero help your eligibility for any of these exclusions, deductions, and credits that we just mentioned? And the answer to that is no. All right. No, in most cases, the MAGI limitations are eliminated once you get somewhere in between that 12 to 22% tax bracket, which means that if you get down to the 12% tax bracket, that you're in the clear in terms of your eligibility in general for a lot of things we just mentioned. You're eligible for it. So practically speaking, if that's what you're trying to do, you're trying to be eligible for some of these credits and exclusions and income thresholds that are measured in some cases, then if you get down to that 12% tax bracket, you're good. You don't need to go much further than that. I just want to add one more comment onto this, and that's, or two more things. So once you get down to that 12% bracket, for example, this is the reason why it gets less practical as you go, right? Say you're at the 37% tax bracket. Every dollar you can save in tax savings, okay, is going to save you 37 cents. If you're at 24% tax bracket, it's 24 cents. Once you get down to 12 or 10% bracket, you're only saving 10 to 12 cents per dollar, right? So every time you have a dollar of loss, for example, we'll talk more about the strategies again in a second, but for every dollar of loss that you have, it's not as impactful for you. So you might be putting investment dollars into an investment simply to reduce your taxes, or buying business equipment or racking up business expenses to reduce your taxes. Meanwhile, it's just diminishing returns on that. Here's the last thing I'll say on this before I kick it over to Ryan. If you are at the 12% tax bracket, if you're married filing joint, okay, if you're at the top end of the 12% tax bracket, you're going to pay only $5,147 roughly, okay, give or take, so roughly $5,000 in taxes total. Now, if you're single, it's going to be roughly double that, around $10,000 or so. So you're not paying that much taxes once you get down to these lower tax brackets. And on top of that, you're going to qualify for many of the things that are impacted by MAGI. So that is just something to keep in mind. Ryan, is there anything you wanted to add to that?
Well, first, so Tom, I think we got that backwards. I think it's single and married filing joint were backwards there with the $5,000 in taxes and $10,000, because the married couple right there, top of the tax bracket for 12% is going to be like more like 94. And then the top of the single is going to be like 47. So I think that was just a flip there, just for people listening, a technical correction, if we want to call it that. A flip flop there as people are listening. But just to continue on with what Tom's saying. So one mentality that I have too is, how big is the jump from one bracket to the next? Not only the modified adjusted gross income information we just talked about, but what's the jump from one bracket to the next? For example, going from the 22% down to the 12%, that's a 10% cliff there, right? It's a pretty significant, like almost half from 22 to 12, right? That's almost half of the 22, right? So that is another aspect as far as how efficient, how effective is my extra dollar of losses that I'm looking for? How effective and efficient is that extra dollar? Could that even potentially be used more efficiently if we've already got a lot of losses in a single year? Should that be something that we consider taking next year, right? So it's not all just about getting all the losses or all the deductions in one single year, but we want to kind of look at this as a multi-year thing and evaluate what are the goals of the client, you, right, the person listening, and then what is kind of the income expectation into the future. For example, if we have someone who's got maybe $200K in income this year, okay, it's going to put them in a certain bracket, I think 22%. But if they tell me, hey, I'm going to make 400 grand next year, okay, we might be now looking at the 30s, right? We could look this up. 32 or something like that is what they're probably going to be at, right? So every dollar, if we wait to get those losses next year, as far as maybe doing something like timing a new investment, when to use a cost segregation study, things like that, right? It's going to be more efficient simply to wait. And even the time value of money, because we're talking about maybe a 10, 15% difference in the tax rate, that's still pretty significant, right? In order to say, hey, let's wait one more year in order to claim that loss in a certain year. So we have to be considering, as strategists who are helping clients, right? One thing we're looking at is income. What about the future? What about this year? What's your goals? What's coming up? What did we maybe do in the past? Things like that. But we're also, just for this episode, primarily talking about the rates and kind of impacts of modified adjusted gross income, like we've already talked about, deductions, credits, exclusions, things like that. So again, the main comment is, really, should you get to 0%? Should that really be your goal? Not necessarily, because overarchingly, that's just not as efficient, right? Because even if we're going from 12%, 10%, it's just every dollar of loss isn't really there and maybe justifiable. We should maybe be looking at a different year.
Yeah, absolutely. Very well said. Getting to zero doesn't always make sense. Now, having said that, I don't want people to be afraid to go to zero, right? Because
Yeah.
there's some cases, and for example, there was a client many years ago that this was before the CARES Act made W-2 income no longer business income. So they were not subject to the business loss limitations on their W-2 income, and bonus depreciation was at 100%. So they were buying very large properties, and they ran a cost seg on one of their properties, very large property, wiped their income to zero, and then they had an NOL, a net operating loss, which is what Ryan, it's when you reduce, it's when you have a loss, like basically your losses completely wipe out your income and then some. So your losses, you have zero taxable income, and then your losses carry over to the following year. All right. And that's going to happen sometimes. And don't be afraid for that to happen. We're just simply pointing out the fact that it's not necessary to always go to zero. It's not always practical to do that either, because you're not really completely optimizing all the time if you do that. But it could happen from time to time. That's okay.
So one other thing, just to mention and highlight too, because some people will come and say, oh, they're thinking about financing, right? Oh, should I actually get this to zero? Because now you're going to show on your tax return when you submit your information to your lender, oh, I have zero taxable income. Okay. That loss, depending on what it is and what it's from, yeah, that could be an issue as far as how much you can get for a loan or whatever. Okay. Here's just the one thing for real estate investors that's specific. If you are working with a lender, you need to make sure that they are considering adding back depreciation expense. Okay. That is a common question I get, a common concern that we get. Make sure that you're asking them, hey, when you look at my income, on my taxable income, you're going to see a huge loss or whatever. Guess what? That's mostly from depreciation. Check with them. Are they adding that back into your income? Because that is not a cash expense, right? That's simply taking additional asset cost, right? And basically moving that forward for the depreciation. Okay. So just making sure that they understand that, they're checking that and so forth. The other thing, Tom, that we were going to talk about here too, is just the overall kind of financial well-being, right? If we want to call it that, because some people say, hey, I want to get my taxable income to zero. Well, that might mean you are either, we're going to get to this in a second, buying a bunch of businesses, buying a bunch of real estate, meeting these specific criteria in order to do that. Does that really fit with your current lifestyle, with your overall financial goals, with where you want to have your assets, things like that? So we always try to bring it back to this, right? Don't let the tail wag the dog sort of conversation. But this is part of that conversation. We need to make sure that we're evaluating other things other than simply tax savings. That's just one aspect to your finances, not the whole picture, not the only goal. From a tax strategy perspective on this podcast, the things that we talk about, yes, obviously that's a primary focus because that's where we help people. But just want to kind of bring people back out of that and think, hey, this is a bigger picture thing too.
Yeah, absolutely. It's not just about the taxes. It's about your lifestyle and how you want to live your life. So you don't want to let the tax tail wag the dog. Now we're going to get into perhaps the most exciting part of the episode for some people. I know a lot of people are like this. How do you actually reduce your modified adjusted gross income, or MAGI? All right. So some of these are not going to be a surprise. Okay. So ways that you can reduce your modified adjusted gross income is by qualifying for the real estate professional status. Now, if you're not a real estate professional, your rental losses are added back to MAGI, assuming any of them are eligible to be deducted anyway. So they're being added back. But as a real estate professional, they are not added back. So one way to reduce your MAGI and thus your taxable income and that your taxes you're paying is by qualifying as a real estate professional. I know we've had a number of clients over the years Again, specifically in the medical profession, in my experience, where you'd have a married couple, one spouse is a high income earner, the other spouse is maybe part-time. The part-time spouse, or maybe they don't work at all, right? They go ahead, they qualify for the real estate professional status, and then they're able to use the losses to offset their spouse's income and be able to help them reduce their student loan payments, right? Again, remember, student loan payments are impacted by how much income you're making, and that's often going to be looked at on your tax return, okay? So that's one use case I've seen of this. Of course, the short-term rental loophole also applies. If you qualify for the short-term rental loophole or strategy, those losses will help you reduce your modified adjusted gross income. Now, you also have oil and gas working interest. Remember, oil and gas working interest, and we talked about oil and gas a bunch here on the show with Troy, so you can go back and check those out. But the oil and gas working interests, okay? The oil and gas working interest, those losses, because they're non-passive, will not be added back to your modified adjusted gross income. A few more here. We have running a business, right? So if you run a business, you can deduct expenses such as vehicles, supplies, equipment, things like that, your normal operating expenses. That can help you reduce your modified adjusted gross income.
Another one would be HSAs, health savings accounts. Those aren't going to be added back for your modified adjusted gross income calculation. Second would be maximizing retirement contributions, right? 401k contributions, things like that. That's also not going to be added back, and that's helpful for you. And then a third one could be like strategic charitable contributions, right? You kind of might be doing some sort of charitable bunching strategy. Maybe there's a year where you want to have a lot in a specific year and then maybe meet the standard deduction the next year and kind of group when you do those charitable contributions in a single year instead of spreading them out between 2 years. So those are three other ones as far as other ways that you can reduce your MAGI and still benefit from a lot of these other credits, deductions, exclusions, things like that.
Absolutely. Absolutely. So many of these strategies, and this is not a comprehensive list of all the ways to reduce your MAGI. These are the common ones, especially for real estate investors that we'll see. That's just important to note. Now, let's just quickly recap what we learned today before we wrap up this episode. All right. So first things first, a lot of investors do come and ask the question, should I reduce or can I reduce my tax, or how do I reduce my tax liability to zero? I don't want to pay any taxes. Sometimes it's just, for bragging rights. Sometimes it's practical, right? Like we talked about, the modified adjusted gross income. Your modified adjusted gross income is going to either allow you to take certain deductions or not, right? Sometimes reducing your taxable income, and through that process, your modified adjusted gross income, there's practical purposes for doing so. However, you do not need to reduce it to zero, right? If you get to that 12% tax bracket where you're going to be paying, again, if you're single, roughly $5,000. If you're married, roughly $10,000 in taxes. Okay, that's all you're going to be paying. But once you get down to that tax bracket, you're eligible for most of these credits and exclusions and all this good stuff that we're talking about here, right? So you do not need to get it down to zero. We also discussed, and Ryan made a good point, that also you want to optimize your situation, right? Every dollar that you have available for deduction at the 12% tax bracket is only saving you 12 cents. At 10% bracket, only 10 cents. Those losses, those deductions might be better saved for future years. So you want to be strategic about it. And the last thing I'll say on this, before I kick it over to you, Ryan, for any closing comments here, is that you also should not be afraid to let it go to zero at the same time, right? You don't need it to go to zero. And for all the reasons we just discussed, however, sometimes it will go to zero. Maybe you purchase a large property. Maybe you have a loss in a year that just, it's unavoidable to take you to zero or below that. And that's okay too. But the point is, in general, generally speaking, to answer the question, should I take my tax liability to zero? In many cases, it generally does not make sense to take it to zero from practical purposes. Usually, once you get to that 12%, again, keep beating this horse here. Once you get to 12%, you're eligible for all this stuff. And then on top of that, it's just diminishing returns from there.
Yeah. And the other thing too, that might be a concern or a question that comes up as people are listening to this is there like a higher audit risk if I get my taxable income to zero, or if I've got this big NOL? Not necessarily, right? I don't want people to hear from us like there's like this big like audit risk, or I'm for sure going to get an audit or something like that. It really just depends, like the facts and circumstances, what you've done. Do you have legitimate deductions and losses and things like that? Have you met something like the short-term rental strategy and then done a cost seg and now we've got this big loss? Great. Don't be afraid to get to zero if that happens, or even an NOL. We have seen people do that. But also, it's not necessarily just, hey, you should get to zero. Don't let that be the goal. But if we're aiming for like, hey, what's like a good place to end? 12%, right? And that's a moving target. Every year, the IRS is going to change their tax brackets, rates, things like that. If we have an election, coming up here, they like to change the tax law on us. So that's always subject to change. So just one, be careful of like being concerned about this whole IRS audit risk, things like that. It's not guaranteed. Don't be afraid of that. But yeah, just to highlight one more time in what we're really trying to say in this episode, don't let zero be your goal necessarily. For some people that will be, or it just happens to be because the business did really terribly in a specific year. That's okay. But really, we want to point people to, hey, to get the most number of credits, deductions, exclusions, things like that, even just falling into that 12% bracket, that really should be kind of your goal.
So as always, okay, we're going to wrap this up. That's going to be about it for today's episode. However, if you are looking for a new CPA, if you are looking to reduce your tax liability, perhaps not to zero or maybe to zero in some cases, we're available to help. Okay. You can go to www.therealestatecpa.com/podcast. Go ahead, fill out that form. Let us know about your situation, what you're looking for help with, and we will follow up with next steps. And last but not least, if you are a CPA or EA, you're looking to make a change, you want to join a real estate CPA firm on the cutting edge, okay, you can go ahead and apply by sending us an email with your resume and a brief description of what you're looking for, okay, so what role you're looking for, at onboarding@hallcpa.com. Again, that's onboarding@hallcpa.com. Go ahead and send us your resume and a little bit of information about your situation. We'd love to learn about you too. That's all for today's episode, and we'll catch you next week on the Tax Smart REI podcast.